Okay, I finished the last video by talking about closing entries. And the reason we have closing entries is because we're reporting on a periodic basis, right? Remember our timeline broken into time periods? 1, 2, 3, 4. So we have to close accounts at the end of time period 1 so that we can start fresh and anew in time period 2. Close them at the end of time period 2 so that we can start fresh and new in time period 3. And the question is, which accounts do we need to close? Which accounts do we need to make 0 so that we can start fresh and new as we move into the next time period? Closing entries are prepared when? They're prepared after our financial statements. So we've prepared our financial statements. Everything looks good. We've got our profit and loss. And we've got the profit and loss flowing into our statement of owner's equity. Because the P&L affects owner's equity, remember our accounting equation. Assets equals liabilities plus owner's equity. And what's impacting owner's equity? It's revenue minus expense equals net income. And that net income figure is impacting owner's equity. So that's why we prepare the income statement first. That's why over here I'm showing the P&L impacting the owner's equity. And then from the owner's statement of owner's equity, prepare our balance sheet. Well, everything that happens here and here are basically temporary accounts. We want our income statement, we want our revenue and expense accounts to be zeroed out at the end of a period so that we can start fresh and new for the next period. And owner withdrawals, any withdrawals that are being made in the owner's equity account, any net income that's being posted to the owner's equity account, we want to make sure that all of that is 0. And the only thing that we actually carry forward is as a permanent, on a permanent basis, are the balance sheet accounts. So it's assets plus liabilities, assets equals liabilities plus owner's equity. So it's assets and liability accounts and owner's equity account as it's been adjusted at the end of a period. This is what we account, and this is what we carry forward as permanent account. Asset accounts do not get zeroed out. Liability accounts do not get zeroed out. Owner's equity account, the actual owner's equity account at the end of a period does not get zeroed out. So this is when we prepare closing entries. We prepare them after our financial statements have been prepared. We talked about in the last video our unadjusted trial balance, and then we make adjustments, right? And then we have, after we make our adjustments, we have our adjusted trial balance in our worksheet. Make adjustments, adjusted trial balance. From the adjusted trial balance, we prepare our financials, our P&L, and we show our financials, our P&L and our balance sheet. I'm going to put financials up here. Financials, P&L and our balance sheet. And after we actually prepare those financial statements, then we have closing entries here. After the financial statements have been prepared, we have the closing entries. And so what we're doing is we're going to take this and look at it from the perspective of, we take our revenue accounts, which are in a T account, have a credit balance. Let's say the revenue account has a credit balance of $2,000. And we take our expense accounts, which is going to have debit balances. Let's say we have an expense account 1, expense account 2, and expense account 3, and they all have debit balances. Let's say this is 100, this is 400, this is 600. What we want to do is we want to take these things, we want to zero them out. And so we want to make them balances 0, and we put them into an account that's called income summary. We basically create an account. Over here, we create an account called income summary that only gets used when we're closing out accounts. So we take this $2,000 revenue balance. We want to make it zero. How do we make it zero? We debit this $2,000, making it zero. And if we're going to debit this $2,000, we credit income summary $2,000. Then we go to our expense accounts, and we want to make this expense account zero. So we have to credit this $100, and we'll debit this $100. We'll come to the next expense account. We want this to be zero, so we need to credit it for $400. So we'll debit this for $400. And we'll come to our expense account 3 that has a balance of $600. We want it to be zero. We're zeroing it out. We're closing it out. It has a debit balance of $600. We have to credit it for $600, and we'll debit this for $600. Can you see that the expenses are here? The revenue is, use a different color pen, revenue's here. The revenue's here. That red check goes with this. These blue checks here, this 100, 400, 600, go with these blue checks here. That. And now in one account, income summary, we see expense and revenue summarized one place. And we can actually see what's the balance in this account. Well, it's a credit of $2,000, debit of $100, debit of $400, debit of $600, which is 6 and 4 is 1,000, $1,100. So we're actually going to have a $900 credit balance in the account. And if you're making the connection, this would be our net income. That's the net income. This is what showed on the P&L as net income. And that income summary now is what we're going to close into our owner's equity account. Remember we talked about this right here? The net income, right, goes into and impacts owner's equity. So this income summary is now going to get closed into owner's equity, and it's going to get closed into owner's equity as a, let me draw a T account here. Call this owner's equity. It's going to get closed into owner's equity as debiting this 900, crediting owner's equity 900. Let's say the beginning balance in owner's equity was $10,000. Then we're going to have $10,000 plus the net income of $900 gives us $10,900 as an ending balance. Now I haven't taken into consideration withdrawals. That's the other piece to this. Any withdrawals that the owners made are going to show up in owner's equity as debits over here. So let's just say that during the year the owners withdrew $700. They withdrew $700. So we make our $700 here. What would our actual balance be? 10,900 less 7. It's going to be 10,200. Just follow the debits and the credits here. This 900 is the impact from net income as a positive addition to owner's equity. The $700 is the withdrawals, and that's the other entry that's going to have to get closed. The owner's withdrawal account, or the capital account. The withdrawal account is going to get closed so that it too reflects a zero balance at the end of an accounting period. So the revenue accounts get zeroed out. The expense accounts get zeroed out so that we can start with a brand new P&L. Okay? We want our P&L to be fresh and new. Fresh, new. And then any withdrawals that the owners have made, anything that's being reported over a certain period of time, that's going to get zeroed out as well. So the owner's withdrawal account, any withdrawals from the owners are going to get zeroed out, and that will be starting fresh and new. So the P&L is going to be fresh and new, and the statement of owner's equity is going to be fresh and new. A lot of scribble on this page. I think it will make sense. It's pretty intuitive. This chapter doesn't have a lot of difficult concepts. We're taking certain accounts and we just want to say, hey, I want to make sure these are all zero so we can go into the next period. And those accounts that get zeroed out are called temporary accounts. They're the income statement accounts, the revenue and expense accounts, and they are the withdrawal account to the owner's equity account that gets zeroed out. and then we have a fresh balance sheet to start the new period. And actually, let me just pick this up in the next video and talk a little bit about a post-closing trial balance and see if it helps tie all this together. See you in the next video.